We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back, everyone. Hope you guys are having a great day. As always, today we're going to be talking about a couple stocks here today. In fact, we won't start with PayPal. We're actually going to discuss, because it was actually requested. I saw your comment, David. You're hoping for us to discuss NVDA shorting right before you go to bed. So I will go ahead and do that here for you. So before we get started on that, we have to discuss the context. So if you guys are, I guess, hearing this for the first time, there's a much larger YouTube channel called Everything Money. And the main creator there, he is the self-proclaimed, what do he call himself? The LeBron James of investing. And he looks down upon a lot of investors out there, while he himself has unverified return rate, very questionable return rate. But we do know some things, because there's plenty of people within this community and other communities that have at least been able to pencil out, based off of some comments he's made, roughly speaking, what his investment returns have been. And to say the least, that they are probably not in the positive. And we have confirmation today that he actually exited the position. So we're going to be going over a couple things. I'm going to be shouting out Stone Cold Investors, who actually came up with the precise, or not precise calculation, it's more like an estimated calculation on how much capital this individual has lost. And like I say, for all of the other people that we might have levied criticism to, I don't think any of them have Paul beat. And that's actually really bad. That's quite shameful, because he's also, I think, one of the more cockier people here on YouTube. He has a lot of capital that, doesn't really matter where he got it from, but you guys can do your own digging as to where it probably comes from. And so I'm going to share with you the video clip that one of the people was nice enough to share, one of the birdies. And so we shall go only to the exact part where he says, and it's around the 41 minute mark. Let's see here. And I'm only going to show you this clip. Let me just set it up for us before we get there, because this is from their stream. And I'm going to just quickly get to the part first before I share it. So there we go. Let's press play, and it should be this part. I'm just seeing that it's this part first before I show you. I don't want to waste it. Around the 41 minute mark. All right. So I'm going to share it with you now, and we'll go from there. Okay, so let me just make sure. I'm going to check audio tab, share, and we shall watch. All right, I'm going to press play. Hear it from his own mouth.
You should have listened to Mo. He always says that markets only go up. You're 100% right, Scott. Guys, my short, I exited my shorts because I had to deal with my brother. Once it hit a certain level, I was exiting, and we hit it, and we exited, and that's that. Onward and upward. I screwed up. It was a bad play that I thought would work out, and oops. All right, move on. Onward and upward. It's funny. It's way less stressful now after absorbing the loss than it was hearing my brother every single day going, the market's up, the market's up. It's like, okay, I'm not blaming him. It was my fault. It was 100% my fault. And I'm actually paying him back for his loss in the short. Oh, I promised. Yeah, I am, because I said to him I did something that he didn't want me to do, and I lost money, so I'm paying him back.
With not probably his own money. Unlikely that it's his own money. But yeah, that's neither here or there. So that point, and we'll kind of discuss this other next part in a second, because this is also pertinent to the conversation and much needed context. And again, this shout out to Stone Cold Investors who did this rough calculation. I hope to do a good job of explaining this chart. So this chart here is a compilation, or an estimation, better yet, of what the potential loss of his shorts were. And this is actually being quite generous. Let me actually stress that. This is being quite generous, because it implies a couple things. It implies that when he sold the shorts at the time roughly that or let me actually backtrack because I'm assuming you guys know the full story. Let me actually explain the backstory here. So Paul from Everything Money, if you guys don't know, he shorted NVIDIA last year. And you guys know, roughly speaking, how NVIDIA did. So let me share this tab instead and show you on the 5-year chart. In the beginning of 2023, let's call it January, February, the stocks incentives returned 232.22%. One way of shorting is, you go to your broker and you short the stock, which is essentially you borrow the shares and you sell them right then and there. And this is, of course, quite dangerous because the maximum potential gain is going to be 100% minus any fees that you incur during the short. And at the same time, you're taking on infinite loss potential. So normally speaking, shorting is a very dangerous game. There's also buying puts, which depending on when you're buying that put, when the expiration is, and for what strike price, you'll also have different risks to account for. But your losses are mainly limited to the put, which makes a put more attractive. So purchasing a put. Then there is a third option that is probably one of the, let's say, most brain dead ways of shorting. And the LeBron James of investing elected to do that one. So this is a story for all of you to kind of take heed with and never emulate this. Don't ever do this. So he took the fall for you. Never, ever, ever do what this guy did. This guy doesn't know what he's doing. So what he effectively did is he sold naked calls. And this was, again, covered in a prior live stream. But selling naked calls, what you're essentially doing is you have very limited upside potential. It's just the premium that you've collected. And when we say the word naked call, what it means is he doesn't actually own the underlying shares. So at that point in the future, he could be called to purchase the shares at the market price, and he will be forced to sell it at the agreed upon price. So to my understanding, when we're doing this calculation, when Stone Cold Investors had done this calculation here, and thank you, shout out to him for sharing this with me, he gave some, let's call it favorable concessions to Paul. One of them being that he had sold them more in the money. So he collected the most premium possible, because if he sold it slightly out of the money or further out the money, then he collected still around the rough estimate premium, where, again, according to his own words, was in the several millions in premium, because he said, quote, my max gain was in the millions. And so if you're doing a naked call, what that implies is you sold and you collected premium roughly worth in the millions. And we're going to say in this calculation that he did it more in the money. And so he collected tons of premium, but not many contracts were sold. Now, if it was more out of the money, then there were probably a bunch more contracts, and the loss implied is actually quite more than what we have here. So this implies a rough loss of about 10.7 million US dollars. That would imply a loss of today alone of $562,800. Now, again, because he doesn't show anything as far as percentages go, you only have certain keywords and statements that he's given over a period of time to go off of. One other calculation that's not shown here that, again, so-called investors, I and Dan have discussed more off camera, is the rough calculation of the family office is speaking, in the manner of speaking, about 100 million US dollars potentially. So at the conservative estimate, he's lost roughly 10% of the family office. At the more aggressive estimates, he has potentially lost, I think it was closer to the 40 or 50 million. So somewhere in between there. If you just want to go with the conservative, that's still quite the massive L. If you want to go to the more aggressive estimate, that's getting, to, let's call it, ballooning it up a bit, and he'll probably be he'll be in trouble. I don't know what to tell you, because based off of that clip that we just saw, I can't imagine that the family dinners are going to be happy. There's probably not going to be any. And just to keep in mind, again, we levy criticism to a bunch of people on YouTube. That's all fair and good. No one holds a candle to this guy. This guy is like the top of the top, right? No one, I think, has lost as much money. Maybe Meet Kevin, but No one has lost as much money as this guy because this is on the lowest estimate. I think he's probably a third or a half of what me Kevin probably estimated loss. Oh, by the way, I also want to this just came to mind. Me Kevin is going through something familial wise, and I also want to just say he's not going to watch this, but to all of you, you should probably put the other stuff to the side and maybe you know, in a way, it's a, how do I say this? We don't want to put the family involved with our criticisms to the individual. And I do genuinely hope that me Kevin's child does pass through this health scare, and that, you know, they feel better and they live a full and happy life. And so I think all of you also should, you know, if you see that, it's perfectly fine to feel that way, and then separate the man from, you know, the family, and, you know, keep them completely separate. And I agree that's a general policy across everyone. So, but put that to the side, because I was just criticizing me Kevin for losing tons of money. This guy, no one holds a candle to him. All right, so I feel like we've covered Paul for long enough. I think that him closing the short today is something that he'll try to sweep under the rug. He doesn't show anything. Even if you're a paying member of his community, you don't get to see anything regarding his portfolio because that's for legal reasons. I assume actually it might be some truth to that he's not allowed to show it because it's his family's portfolio, and he can't show that because family portfolio and stuff, it's not his. So I imagine that that's one of the reasons. Meet Kevin is shorting Costco. Meet Kevin is short too. Yeah, Meet Kevin is short Costco. I'm aware of that. Echoes versus Strongman. So I can give my quick thoughts on that because there's a little bit of a civil war brewing between the two creators. And actually, if you guys think I'm in constant communication about them on this, I'm not. I'm watching this develop just as much as you guys, so I'm as much aware of it as you guys are. My quick and dirty thoughts on it is for Palantir that Echoes is saying. He is basically saying that he thinks that he was wrong on Palantir and that it's not a terrible company. I saw his reaction video to Strongman's reaction, and I listened to him kind of say that he was comparing it to the likes of Tattooed Chef and other companies. I would agree if that's how he was viewing it, that it's not in the same realm whatsoever as those two, because at the very least they're producing positive cash flow, irrespective of everything else. The company's not at risk of going bankruptcy, that's for sure. But the other components, I understood what Strongman was also saying about enabling. And I think that was what Strongman was hitting hard. And then Echoes was also hitting back in some other cases. I'll be interested to see how that develops, but that's my quick and dirty thoughts because I haven't put too much time or thought into the debate between those two individuals. Hope that's I can't dunk on LeBron, so I can't short like him either. Thoughts on Palantir? I think Palantir, like other companies, are what Kevin closes Costco short today at 1 p.m. Oh, thank you, Jason. Okay, so he also closes shorts. We had two people closing their shorts. I think you have no business shorting on fundamentals alone. There's got to be some catalyst. But yeah, thoughts on Palantir. I have a hesitation of getting involvement in individual stocks that have extreme, let's call it, retail followings. I don't care to follow retail trends. I know that for YouTube, for all content creation, YouTube, Twitter, whatever, it's to the benefit of the creator if they fall in line with content trends. I again remain, and all the club members know this, that the most material impact to my own wealth is actually portfolio performance, not making silly clown videos on YouTube. So there's that. Now sounds like now's the time to start shorting. Oh, you're saying for NVIDIA and Costco because these guys are closing their shorts. Well, I don't know, potentially. I generally, it would take quite a lot for me to initiate a short. I rarely would ever do it. How does it feel being on fire? It feels really good. You're referring to, of course, the thumbnail, and of course, some of you know who the other individuals are in my thumbnail. So shout out to you guys who do know that. Answer the poll as you guys are joining in, and we'll kind of get to that poll question in just a second. Lesson learned. What do we short next? He mentioned it in his Discord. Okay, so thank you, Jason, for the context on me, Kevin, closing a short. Okay, so Furthermore, what is this notification? Furthermore, we're going to be discussing the earnings of PayPal. So PayPal released their earnings today and showing you guys the performance of the stock. It's been quite disappointing, to say the least, for investors. I feel bad for you. It's down to about $58.29, down 7.83% after hours. We'll be discussing in short order what exactly happened. All Fabios are communist Fabios. Yeah, that's true. All right, I already have the earnings chart listed out for us. So let me actually put us here, and then we'll kind of go through this. Let's get this bag. All right, so the guidance, let's start with guidance. I think the most important parts or components of this earnings report was, of course, the guidance. Actually, no, scratch that. I lied. We're going to start here on page 7. So active accounts year-over-year growth, we do see on the full year basis, it's down 2%. If you guys have been following along the previous PayPal analysis videos and live streams, roughly speaking, we were kind of guiding that in order for this thesis to really work out, you have to have a maintenance level across the legacy business and really strong growth across Braintree. If you don't really have that, I don't really see the story playing out favorably. They're going to have a lot of competition encroaching from all sides. It is an industry that it is quite literally a race to the bottom. I do not know. And actually, shout out to you, Dan, because you say this all the time. This is your, I'm going to steal your words here. This is your grandpa's fintech. PayPal is your grandpa's fintech. The growth here isn't quite exciting. The moat isn't very defensible. When you really look at fintechs with really strong defensible moats, I mean, look no further than Visa and MasterCard. And then you have some people out there that even compare or dare to compare PayPal to Visa and MasterCard. That does not make any sense. PayPal has some interesting and exciting components of the business, mainly the Braintree, but you have Adyen, which is out there, a standalone company with which much better business fundamentals, much better growth prospects, and frankly, I think a bit better management team than PayPal. PayPal right now has an unproven management team, so I don't want to diss him too much. He has more to prove to the market, and so far, he's sort of been over-promising on, let's call it the cheerleader side of things. What I mean by that is he said that he was going to shock the world. He went on CNBC. I always love that, by the way. I love when CEOs go on CNBC to explain why their stock is good rather than the numbers talking for themselves. Always a good sign. But when you have the CEO come on CNBC and make a bold claim like that, followed by not the investor day, but I believe we can classify that more as like a merchant day where they're discussing the products for the merchants. It doesn't seem like too much strides and innovation were made. Now, the parts that were, I guess, interesting, just stepping aside and judging it on its face value, it didn't shock the world, but there are some marginal improvements. I don't think the advertising part is very interesting at all. It just seems like they slapped on another product, like Rakuten, they have a honey. So they already acquired honey. It seems like they're just kind of slapping it on, but in a different way. And when you really get down to it, this product has existed for quite some time. I imagine many of you watching me, based off of demographics, you are old enough and you probably have credit cards. So if you go on your bank account and you go on the app, you can see that they have these deals available for you. And then in those deals, you get like, okay, 10% off if you spend at this merchant, $10 off, some sort of, pretty interesting deals. You should be utilizing them if you can, by the way, but that's not about this topic. The point is that product has existed for quite some time. It's not really innovative. You have already had that available at your fingertips. And I'd much rather do that through my credit card where I get additional reward rates. For example, with Bank of America, you can cash back in excess of 5%, depending on how much money you have with them. And then on top of that, you can double dip and get an additional percent back. Again, this is speaking for American consumers, because I know in Europe it's a little bit different. So we have a comment here. PayPal is the ultimate value trap. The market got it right. Go figure. So there are some people who are, a little bit, let's call it, clapping back at me for my comments on PayPal. And, again, you could completely, I hold this opinion, you can pick worse out there, but it's a very strange hill to die on. And I maintain, like, within these fintech names, I don't know why you think PayPal would be so much more exciting when again, you have Adyen right there. But a lot of people are choosing PayPal. And the arguments I hear levied forth about why PayPal is more attractive, just don't make all too much. Well, not compared to Adyen. People just say it as a general attraction. I firmly believe this, that a lot of the PayPal investors are people who just missed Meta, and then they're applying the same narrative to a completely different company. By the way, if you're liking the stream so far, feel free to like it if you're on YouTube. And if you're also on Twitter, you can heart it or like it there and retweet it if you so wish. But that's how you support the channel. Okay, so with that being said, getting back to the content, there's another part that I do want to discuss, and that's more on the, well, this is something I'll give them kudos. You see the transactions per active account, TPA, year-over-year growth, 14%. Now, this is actually quite positive. So I don't want to be all negative Nancy. There are some good things here. What this is essentially telling me is this trend of the less active accounts are going off platform, and the accounts that are staying are using it more and more and more. So this is a positive that we can take away from this earnings report. So total payment volume did, of course, increase. And okay, this is another part that's good. But remember that a lot of this growth might be driven by Braintree, which is going to have a lower take rate. And of course, the take rate did come down a little bit. That's shown, I forget in what slide, but take rate did come down. Okay, they don't have it there. I don't see Braintree here, but the take rate's shown somewhere. If I don't find it in a couple seconds, just trust me, bro, on that. Take rate came down just a tad bit. Revenue did grow, contributed by, I think it was like grew 9%. We'll talk about this free cash flow because I do want to come back to this. Transaction margin. Oh, I think, no. It's listed out somewhere. Hold on. Okay, sorry about that. Take rates on 15. Thank you. Take rate. Oh, there we go. Okay, thank you. All right, right there. Transactional take rate down 10 bips, 7 bips of decline driven by lower gains from FX hedges. But yeah, there it is. So I just wanted you guys to see it for yourselves. Take rate is down a little bit. Again, I would expect that as we see the continuation or growth of Braintree, because Braintree is going to be a lower take rate business. But again, that's a more exciting business of what they have. Venmo, I think, is a mismanaged asset. Frankly, they're getting their butts kicked by Cash App. Cash App, I think, has provided a much better product than what Venmo is. And Cash App has also resonated a lot more with the younger crowd. So one of the things that Cash App does that I think is better, but doesn't mean that Venmo can't implement, is looking at, for example, investing in stocks, because you can do that on Cash App, but you cannot do that right now, as far as I know, on oh, I see. This is Dan messaging on Venmo. And then we have a comment from here. I hate Venmo. I know that's anecdotal, but that's how I do feel a lot of people kind of have I guess, a sense. Because at the end of the day, how do you monetize Venmo? Any increase in sort of charges that you do on your customer, you're competing against the free option. And it's very difficult to compete against free. Because again, you're in an industry that it's a race to the bottom. What is your moat? What are you defending? So wow, talks about fintech and not Square. Sad. So this is a reference that I think we're going to start a cult around Square. So if you ever see me make like not satirical, very serious videos on why Square is amazing, now you know. How do you monetize your pals? Exactly, PayPal. I always tell them to Zelle if they can. Yeah, and I think Zelle is also so convenient because it's like tied to your phone number or tied to your email. So it's really easy. It's free. Of course, there are the limitations of how much you can Zelle. That's the current only drawback. But realistically, most people, I don't think, Zelle enough to get past those limitations. I think the numbers are off the top of my head, I think it's like 2,500 for personal accounts and 5,000 for a business. They could have changed. but that's what it was like years ago. And I just don't pay attention to any updated maxes that they allow. So LeBron got face video short, Bill Ackman Netflix trade. Venmo's the opposite. In my group, no one uses Zelle. No one uses Zelle. Okay, well, I don't know why people don't use Zelle in that case, because Zelle is so quick, more direct. It goes straight from your checking to another checking. There's no third party. It seems like Venmo is almost a middleman. And from what I gather, the underbanked crowd is actually in Cash App, and that actually provides an additional service that they don't really receive because, again, they don't have that bank account. They're called the underbanked crowd. For lack of a better term. And then Venmo services seemingly like the somewhat banked crowd. And so it's a lot of people that do have a banking relationship, and then they transfer either via, their checking account, or they have a credit card, which again is a banking relationship in a way. And you attach your credit card to Venmo. And of course, Venmo at that point takes fees or charges you for that because they're not going to pay the credit card fee. So 3,500 now. They changed the limit. Okay, thank you for letting me know, because I forgot exactly what the limit are. Block also has Square B2B platform and Afterpay, buy now, pay later. Exactly. So Block has all their interesting businesses that also compete against PayPal. So PayPal isn't necessarily alone, and they're competing in some capacity against one business, and the only one that they currently dominate is the checkout button. That's it. Everything else, they're not number one in. They're not number one in the peer-to-peer payment platform. Again, I think Venmo is losing to Cash App. They're not number one in the let's call it white label checkout product. That's Adyen for large enterprise and small, medium-sized business. That's Stripe. So Braintree's kind of somewhere there. They're trying to grow, but they're not number one. And so PayPal has only the dominance in the checkout button, which is being heavily challenged by other entrants into the market that basically just said, hey, we can do it too. Why not throw it in? We have plenty of money to invest in this. I see, Fabi. I feel like that isn't a problem for most folks since Venmo is trusted well, and people don't really move money from Venmo to bank accounts often, so they don't think about associated fees. Well, I couldn't tell you. I mean, I think if you have a bank relationship, which if you don't, you definitely should think about that. Unless, well, if it's unfortunate you don't have much money, then I don't know. Maybe you can make an argument because traditional banks, they charge fees, etc. But I think everyone should have a banking relationship. There's a lot of benefit that could be derived from that, specifically in accessing capital for, maybe you want to buy a property, and just building that relationship with a bank is, I think, important. And you should strive for a banking relationship with a mega bank, regional bank, and maybe even a community bank, something like a credit union of sorts. So, and then you kind of can compete or get them to compete against each other for your relationship or your loans. I get your point, though. Why not eliminate the middleman? But it's not visible for most folks paying each other for dinner, etc. Yeah, but the dinner argument, again, it's like Zelle is there, and it's like instant, convenient, no fees whatsoever. So the dominance of PayPal in Venmo, I think that's the irrelevant question that we have here. I think that it's already a foregone conclusion that the dominant payment-to-payment app is going to be Cash App. It is Cash App right now. So let's say that is still the case, and like Cash App and Venmo, are still going to be very prevalent, which I do think so. I'm not disagreeing with your point. My point with it is, even in that space, they're not going to be number one. So they're just going to be like number 2 or number 3 in all categories. And then some of the categories are being attacked or / eroding. So, and I think, again, Cash App has done a better job at providing a superior product than what PayPal has offered. So that's my criticism. Okay. Will Venmo snitch on me to the IRS? Well, you should report anything anyways in excess of 600 to the IRS. It's going to be automatically done, but anything, if you received over $600 in Venmo it's going to be reported to the IRS. So yeah, keep that in mind. Don't get in trouble with your taxes. Right. Agreed with the overall point. Yeah, of course. Why should I have a relationship with a bank when okay. So the other point of concern, we'll get to the free cash flow. I want to get to the earnings. Earnings was guided here. Total payment volume, total revenue. I think it's going to be down there. Total payment volume. Oh, wait. Non-GAAP. No. Where's your EPS guide? They had an EPS guide. Basically, it came out to being roughly flat from this year. So they're expecting roughly no growth. It's on one of these pages. I saw it earlier, but I didn't like jot down where everything is. If I search guide. There we go. Okay, so I wanted to see this. Okay, so non-GAAP EPS, mid-single digit growth. So again, barely any growth. Non-GAAP effect. Okay, we don't care about that. Revenue, non-GAAP, free cash flow, roughly about the same. Share repurchases, they're putting pretty much everything into share repurchases, which I guess you could say. I'll put a. Oh, I just saw your comment, Jill. I just found it though. And then GAAP EPS right there, mid-single digit growth. Again, practically no growth. So basically what we have here is a business that is struggling to find growth. And so the narrative is sort of caving in on them. Fabio wants you to be trapped in legacy banking. Not true. I'm just trying to illustrate why there's a huge benefit to having those banking relationships. And I think people, I guess it's not talked about enough. So anyways, so we're not expecting too much growth here. And again, that's not what the market wanted to hear. The market, going back to the share price, the market did not want to see that, oh, we're just not growing anymore right now, or for the time being. And so if in the future, later this year, they are able to kind of figure out a new strategy, or something starts to pan out from their current strategy and forward guidance starts to change, become more optimistic, absolutely, this is cheap. The price is implying what I stated earlier. Basically everything is going to slowly deteriorate, or they're going to lose market share over time in the checkout space, and they're going to grow a little bit in this other space. But remember, you're getting an enterprise or a company that's worth roughly $70 billion at market close. Now it's going to be worth a little bit less, but let's say roughly $70 billion where it just was at. And you're not just getting Braintree. If Braintree was by itself, maybe we could have a different conversation, because it'd be completely different. And you'd be comparing it more to a pure peer such as Adyen. And again, Adyen's publicly traded. It's out there. It looks really good. You sort of missed the initial bump in Adyen, but the story is still there. And then Stripe is privately held, so you can't really do it. I think a considerable part of the zero EPS growth is due to lower interest income guidance. So you don't really want to rely though on interest income to drive your growth. So that's one thing. And that's actually something I forgot to mention when I was asked by Lincoln about Palantir. One of the things that's driving a lot of the earnings from Palantir is, of course, still interest income. And so for me, that's still like a kind of a no-go. I don't want to get involved with a business that has a huge reliance on something that is not part of the business per se. It's more of a financial instrument. So they're relying on financial instruments when they are not themselves an investment business. But yeah, taking a look or summarizing guidance, the free cash flow also not expected to grow. I did see that in where was it? Free cash flow. It was, I think, slightly down on the FY23, down 17%. But on the Q4 quarter-over-quarter comparison from prior quarter on a year-over-year basis, it's up 72%. And then they have the adjusted free cash flow measure there. But the story here, this is where I'm going to say my last bit of commentary on this is when I think a lot of people online now, especially retail investors, are really putting importance to share repurchasing. I want to caution this narrative or this mindset. And I think it's because they're looking out and seeing other companies initiate share buybacks and thinking this is just applicable all the time. I think that there's an appropriate time and place where a share buyback strategy really does make sense, a la Musa. If you guys haven't seen my pitch on Musa, it's because I've never done a public pitch. That was always for the club members. And then I did a collaboration with Chit Chat Stocks on YouTube, and I went on their podcast on YouTube, Spotify, etc. If you look up Murphy's USA, I covered roughly the in a public setting the pitch for Murphy's USA, and that was a buyback play. So for full disclosure, I have already taken profits, but that's kind of like, you can use it as a case study. That's an example of what you could be looking for in a buyback story. This is a little bit different. I wouldn't necessarily say this is, well, I wouldn't say whatsoever that this is like the same in any case or any way at all. It appears as though, you know, with a 5 billion approximate free cash flow, you're getting decent yield, and then all of it's going to share repurchasing. That tells me, well, do you not have any other projects to invest in right now? You know, it's not necessarily always a good look when a tech company, a fintech, tells you we're using all excess cash to buy back stock. We have no projects that I could possibly think of that need tons of cash, or it needs very little cash because there's not any new investment plans. PayPal earnings was a shit show. Alex Chris drugged us with changing the world, got us high, and fucked us. Well, let me just start by saying I apologize that you feel that way, but there was a lot that I think people were getting ahead of themselves with this company. And I don't know. I feel like if you're newer to investing and you're following and you're seeing that there's a lot of people, and you look to your right, well, for you guys, I'm doing the opposite, but for this is my left, but you look to your left, you look to your right, and you're like, wow, this is really crowded. There's a lot of people in this. Watch out. Because, you know, that's a, I don't know. I'm not saying it's a rule or a law of nature, but it's a good rule of thumb to kind of observe, like, where is everyone? And if everyone, and even in like some of the sketchier content creators who are kind of clownish are also in there, maybe that's a sign that you probably are involved in something that might or might not play out the way you think it does. So you have tons of coverage by amateurs, which is nothing necessarily wrong with that. Again, it's like not a law, but I'm trying to be nice. I'm not in PayPal, so hoping it doesn't hit tomorrow. Oh, sorry. I'm in a PayPal long SL56. Hoping it doesn't hit tomorrow. Numbers will. Why is I like PayPal feel they are sandbagging guidance. 3 earnings call was, yeah, their earnings call was terrible. Okay, so, I mean, it might. I don't want to make a prediction. I have no skin in this game. I'll talk about a stock shortly that I do have skin in the game. But yeah, you could do far worse. Like, at the very least, the retail investors who got involved heavily with PayPal, you are getting involved with, generally speaking, a very profitable business, right? It's just not growing much. Like, there's things that are wrong with the story here, but far worse companies exist. And that's why when someone, you know, from other communities on YouTube, they get upset, and I'm like, okay, I know it's a strange hill to die on, granted, but, you know, like, far worse could be picked. Far worse cults have been formed around stocks. So, you know, this is an improvement. This is definitely an improvement. And, you know, it could still work out. Like, don't discount it immediately. It could still work out. Just certain things have to play out. That's why I put in the title, like, it's still easy money. It's not easy money. This is an uphill battle. But they can do it. They can do it. Okay, so sorry, man, but didn't get high at all. I feel like it's had a few features already in their product. Yes, exactly. No, I completely 100% agree with this comment here. That's on a product basis. So it was kind of like just over promising as to what the surprise is going to be, and then just completely under delivering there. So yeah. Disney time, let's go. Okay, so I think we've covered enough PayPal. Let's go into Disney. So Disney reported today, and for club members, I've already given you guys just a rough update on it. So we'll go do an update here, and I think it was exciting enough that I'm going to talk about it here on YouTube. So Disney, I had estimates coming in for 2024 as being a period of recovery. But I didn't estimate that they were going to have cash flows sort of emulating prior years. I was estimating roughly $6 billion in cash flows for this year, and they came out with a guidance of $8 billion, which was a big surprise for myself. Bob Iger's commentary on it was, "Hey, look at us. We're turning a corner." I would say maybe a little bit too early to say that, but at the very least, like guidance is surpassing my prior estimates. So when I'm looking at this, and recall that I've done now content on Disney for a while now, when it was much higher back in the let's call it clown market, and everyone was super hyped about their streaming service, and I was negative on it. And then I flipped on Disney once some of the issues or criticism I levied against Disney changed. So once they addressed them and weren't ignoring them, such as park investment, remember they announced the investments in the parks. I think that's like going to be 60 billion over the next 10 years or so. So the underinvestment in the parks narrative, okay, we can cross that out. We have, of course, the management team did not like the management team. We saw them all subsequently get fired, left, etc. They all got fired. Check that out. Okay, then last part, focusing more on the content rather than the, let's call it, messaging, focusing just on the story. I want that to be more applied, and that's still where we're kind of in question. But based off of the changes done at the management level, I do think that in the next 2 or 3 years, we're going to see the effects of that, because when we saw what happened with the Snow White movie kind of getting delayed there, I don't think that movie is necessarily fixable, but we're not going to see the changes get implemented until roughly 2 or 3 years from the start of those changes, just because how the pipeline for movies does go. It's a pipeline that a movie can take a year or 2 years to make. And so a movie that's already we're seeing now was already started in development a while ago. Okay, so let's see. Let's see. Well, yeah, be very careful with that. Wait, so is PayPal cheap enough to buy? Yes or no? I think there's better opportunities. There's better opportunities. So that's all I'll say. It's a very strange place, a hill to die on. So it's just sexy after hours on Disney. Yeah, so if we take a look at the after hours market on Disney, the market did really like it. And I look at this and say, okay, well, you're doing everything that I wanted you to do. Why would I punish the stock? So I'm perfectly fine with averaging up on Disney. There's no problem with me averaging up on Disney after you're showing me that, one, your numbers, first of all, are actually getting better than I thought. And I do have to look at the earnings call a couple times more so I can kind of develop a, let's call it, more grounded opinion on it. But for just glancing at the numbers, it was a surprise. It was a surprise. So now when I go back to my evaluation and I add the, let's call it, new baseline for some of these figures, it starts to get a little bit more interesting. So I probably, over the coming days, and again, for club members, we already discussed this. I'm going to be adding, when I add net new capital, the copier hands, or the copper hands. I'm going to be adding net new capital to this position. So that's the gist with the Disney update. So we have earnings from PayPal, which was suboptimal, to say the least. Market was not too happy. And then we have the earnings from Disney that the market was very overjoyed. We also have, real quick, the earnings from ARM. So ARM stock rising. Oh, it was 30%. Now it's only 19.85%. So market is very excited about ARM architecture. Oh, and we'll talk about this real quick. So let's finish off with Disney, because this is another point. So I did see that they did lose subs, and that was in line with expectation. That was in line with my expectation as well, because I just used pretty much their guidance or their commentary on it as they were raising prices, that they would lose subscribers there. My number one investment in media has been Netflix, and I think Netflix has won the war. I think just Disney has the opportunity to get to number 2, the second spot. Warner Brothers Discovery, you guys didn't ask me about them, but Warner Brothers Discovery has a lot of problems going for them as far as just narrative around their debt. So they can execute really well in the operations, and the sentiment can still be really piss poor. I won't bring out the valuation that I've done on them, but I discussed with club members the valuation. I'll just share it here with you guys on YouTube. Roughly speaking, I think that when I took a look at it, I'm not even interested until it reaches the $9.40, based off of everything that I've modeled out as far as expectation goes and the risks that I see with it. And so right now, I forget what Warner Bros. Discovery is at, but let me pull that up. Just getting into it. Oh, okay. We hit 975. So we're getting there. We're getting there. We're almost there. But that's the price point at which it begins to get interesting, in my opinion. And so here, seeing it here down 3.18%, I'm not surprised. Let me see what it got down to at its lowest point, because I need a reminder. Okay, so it got down to about $9.17. So we might see that. I think on my most conservative estimates, I have got prices of like 7, 6. I don't have the valuation in front of me, but yeah, it was around there. Okay, so Warner Brothers Discovery, the reason why I was bringing them up is if you actually look at the Nielsen data as far as consumption of content, you have YouTube as the far and away number one. Then following that, you have Amazon, which people discount Amazon a lot. And I think Amazon with Warhammer 40K TV show, shout out to that one. That's going to be interesting what happens there. And then following that, you have Hulu, which is mostly owned by Disney. It's going to be basically, let's call it Disney. And then after them, you have, oh gosh, who do you have? You have someone else. I think actually might be Disney. You know what? Instead of guessing, let's pull up the Nielsen data and cover that. Okay. What is it? Was it Apple TV? Here we go. Oh, this is not the most up-to-date one, sadly. No, let me Streaming movies, by the way, Disney has been doing really well. It's just TV shows that Netflix still just absolutely just dominates. I'm going to the Nielsen website. If not, we're just going to use Google is giving me just not the latest up-to-date information, which is unfortunate. Gauge February 23. It's just giving me the top shows for some reason on Google. Just for the sake of brevity and since I already have it up, we're just going to use this. It's not the most up to date, but it's when I looked at the most recent figures, it was roughly the same. It hasn't changed too much. Actually, no, scratch that. No, it is materially different because Prime Video was above Hulu. But I don't need the chart in front of me because I have enough of this memorized. So it was YouTube number 1, Netflix number 2, Prime Video number 3, Hulu number right after them, and then Disney right after them. And then if you combine Hulu and Disney Plus, that puts you above Prime. And then you had HBO Max. And the reason why I was bringing up HBO Max or Warner Bros. Discovery is this is a big problem. They're really unable to actually get a captive audience. And then when there was the rumor that they were going to merge with Paramount Plus, that's how sad it is. Combined Paramount, which was still roughly about 1% in the newest data, with HBO Max, which was also sitting at roughly 1.4%, combine the two, and they just surpassed only Disney Plus, which is really sad. So it's a lot of problems. It's a lot of problems. So yeah, let me see if there's any questions here that I missed. Morning, everyone. Good morning. Just scrolling through. Fabio, does your private group offer guidance on how you analyze companies prior to investing? Well, the thing is, it's a club, so it's not just me. It's myself and many others. And so, yeah, there's write-ups from myself. There's write-ups from other members who are also extremely good investors. And it's a collaborative effort. No. So the weekly call was actually corrupted. I provided a weekly call, or I did a weekly call yesterday. I uploaded the file. It was corrupted, and the audio was just not functioning. I thought I was able to fix the file. I was not able to fix the file, and it is lost to us forever. So what I'm doing is tomorrow there's going to be a new weekly call, and so just be on the lookout for that. So a new weekly call will be tomorrow, and it's good because we have actually more information to go off of, because we have Disney's earnings, we have well, PayPal's earnings. If you guys want to care about that, but we don't really care about PayPal's earnings. But Disney's earnings, and ARM's earnings as well, and then a couple other ones, Paylocity, or sorry, Paycom, not Paylocity, Paycom. So what you get then is like just more content, and then also tomorrow's ICOM. So tomorrow's going to be actually chock full of content, but making up for technical difficulties. Okay, so let's see. I saw a comment. Oh, this one. This is what I was looking for. Google search has fallen off by puts. So I gotta be honest with you. With Alphabet, I've never sold a single share of Alphabet, but they've pushed me close to the edge. They've pushed me so close to the edge of selling them, and what always puts me or stops me from jumping over that edge is Alphabet being such a good business that they can have such bad management. Well, there's worse out there. They're not the worst, but they can have pretty bad management and still just like print tons of cash. So oftentimes, you would say, well, that's a business I want to be involved in. I want to be involved in a business that has the capacity to just mess up again and again and again and again, and then just still put out great numbers, great earnings, etc., relatively speaking. So yeah, I'm amazed you're still holding Alphabet. Dex, it's hard. Dex, it's been tough, especially lately. It's because I'm looking at it, and the way I make judgment calls on selling. I mean, Dex, you kind of see how this goes, and sometimes it made fun of in the holding co by sometimes how I elect to cut a position. But if it's not, the only thing that's saving it is that Alphabet has enough involvement in some of the key ideas that I'm trying to focus on right now that they haven't been cut. And so otherwise they probably would have been cut a while ago. Now, Google search coming off a cliff a little bit. Yeah, it's I've noticed the quality come down. I'm also one of those. So but they have a lot going for them. So there's the Google Cloud component that honestly, in and of itself, as in isolation, is a great business, but adds added value to their other businesses that the other companies that are compete against them just can't do. I'm thinking of course, the likes of TikTok, for example, that doesn't have their own hyperscaler. So the fact that YouTube has its own infrastructure through Google Cloud is a huge advantage to some of these other competitors, mainly the other ones like Rumble, etc. And speaking of Bumble and Match Group, if you've actually been paying attention to their earnings, that has been pretty bad. So if you go to MTCH, just kind of talking briefly about this. This is Elliott Management got involved, and they think there's a lot of value, but the economics here are just not the same in any way compared to something like a Meta, where you have a product that ideally is designed to not be used anymore because you're trying to get one person with another person. And so Instagram is something that will last an entire person's life because there's not really an endpoint at which the person doesn't use the product. And then same with Snapchat. And, not to get ahead in another conversation, but Snap earnings. Oof, what about those? So let me pull up Snap earnings because I think this is almost too much of a joke. Let me pull this up because I looked through it, and honestly, it was pretty bad. So some highlights here. I already have Snap stock. Snap is down 34.61%. Frankly speaking, if you've been following the pattern on Snapchat, every earnings, it seems like it disappoints tremendously and comes down quite a bit. So with Snapchat down 34.61% here today, you have I'm going to be polite. I'm not going to be too mean, but I feel like at this point, you've been disappointed enough times to realize some of the issues. And I think on a high level, the main issue is monetization. How do we monetize all these users? I don't think it's designed properly. So one point here. Oh, sorry, I thought I was sharing this. One point here we'll start is in the daily active users. So 414, that's pretty impressive. But let's look at the composition of the daily active users. Well, the most valuable on what you could derive as far as the ARPU measure is going to be North America. So that's going to be United States and Canada. Let's not forget our Canadian friends. And that's sitting at 100 million. Notice that it's down quarter over quarter. From Q3 to Q4, we lost about 1 million. And so that's already, that's problematic. Taking a look at the rest of the world, this is quite positive, but you're not going to be able to monetize these people as much as you are going to these people down here at the bottom. And then Europe is also still growing, which is good. Also decently monetizable, but not as monetizable again as North America. So this is red flag number one. If this trend were to continue, I'd be concerned. So Snap feels like easy money with puts. I know it feels that way because that's been the trend. And then what we're looking at here is significant opportunity to globally expand our community. So they're pointing out that if they achieve a similar penetration as in North America, then okay, you have plenty of room to grow here in the rest of the world on a daily active user basis. So let's skip over this. Is like their story, how they got there. Pun intended with the story, by the way. They're famous for, of course, their filters. Where is their part? Because I thought this was kind of funny. What is this? Oh, yeah. So like this is the beginning of kind of like, oh, okay, I don't know how true this is, but 34% more likely to purchase products advertised on Snapchat. I think it's just very difficult in the first place to, again, monetize the platform based off how the content is presented. But this is the slide. I kind of chuckled when I saw this slide. By the way, reminder, again, if you guys are liking the live stream, feel free to leave a like and subscribe if you're not subscribed. And that's how the best way to support the channel. And if you're on another platform, like, share on that platform as well. Okay, so going back to content, significant daily active user and ARPU opportunities. So taking a look, this is their showing you, okay, we are a 12-year-old company. Facebook is a 19-year-old company. The average revenue per user, remember, Meta is actually my largest holding and has far beyond and away surpassed everything as far as expectation goes. But the average revenue per user here is around $302. Snapchat is reporting a $30 average revenue per user. So they're implying here that they could get somewhere close to that 300, which I think is quite laughable because that's ignoring the design of the application. So it's only desires to create an app for sending nudes. Yep. That's a good point. Yep. And then again, talking here, opportunity to expand our market share. I think it's reaching a lot, but you see this part. Snapchat comprises less than 2% of U.S. digital ad market, but yet nearly half of all smartphones. I think there's Snapchat on my phone, but I never open it. And again, the problem overall I can summarize with the whole company is monetization. It's very difficult to monetize. And until they figure that out, which I don't see them figuring it out because, again, the app's design, I can't justify an investment. It's not the next Meta, not even by a long shot. So, fintech boy, make me laugh. My shitty fintech company has more ARPU than that. Yeah, it's not great. It's not great. That is for sure. So, by the way, speaking on fintechs, not speaking to you specifically, but fintech has gotten a huge amount of attention from retail investors. I mean, every cycle, it's always it's something. One of them is a bank for whatever reason, but we won't get into that here. So, well, I guess we can get into that. You know what? We'll get into that. So there was the discussion around SoFi. We've talked about SoFi in the past, and I guess we'll get into that here. Let me go ahead and share tab. Let's make this a little brighter here. I lost 100K on PaySafe. So this is another thing. In 2021, we saw a lot of SPACs for fintech companies. They all decided to seemingly SPAC there. There was what's it called? Payoneer, PaySafe, Open Door Technology, I guess you could kind of call fintech, real estate fintech. They give you access to capital. You had what's that lender, that really funny lender? Well, you had a firm, but what is the other one? Come on, but a firm wasn't a SPAC. But oh my gosh, what is, I'm blanking on the name. There's a couple of them. All right, but anyways, fintech went down, bro. This means it's going back up, bro. All right, so anyway, SoFi Technologies gets talked about a lot, and they recently reported in the recent quarter profitability, GAAP profitability, nonetheless. Yeah, 5 million, and so yeah, but give them credit where credit is due. Management said they're going to be profitable. They ended up being profitable. Now, high level overview. Nothing has changed though, because at the end of the day, it's still a bank that caters to one of the more degen sides of the market. And this is speaking from bank to bank comparisons. If you look at some other banks and you look at this bank, you'll see that this bank in particular likes to invest in the more undesirable parts of lending, because the better risk reward sections or markets where most banks, let's call it the serious banks, really want to focus their efforts on, is dominated by other players. Now, that doesn't mean that SoFi can't in the future try to get in there, but the other players do have a significant advantage. The cost of capital for SoFi continues to remain rather high when comparing to other banks. You look at something like a Bank of America or a JP Morgan Chase. Better JP Morgan Chase example as a better run bank than Bank of America. Bank of America runs too conservatively. That's their problem. But in some ways, you could say it's a good thing if you're a customer of theirs. But their cost of capital is extremely cheap. And what I mean by that is, if you look at what on average what it costs for them to borrow capital and then for them to lend out, the difference, the delta between that, is what they're essentially profiting off of. So SoFi's is going to be a little bit higher, but at the same time, they're also reaching out into the higher yield space, being personal loans, unsecured personal loans, and student loans. So you're going to get a bit more yield out there, and they're also paying out a little bit more than the average as far as let's call it savings accounts goes. Now, if you look at the other attractive attributes, you have something that's akin to an Ally, the pitch of Ally, which is you have a bank that doesn't have branches, and Ally doesn't have branches, SoFi doesn't have branches, so this in theory gets you a much lower operating expense for the business, so it can run a little bit cheaper, smoother, leaner. And there's some things here. The other parts of SoFi that a lot of retail investors are really attracted to is, of course, the technology platform, which I think they guided for. I'm guessing by the comments I received that I was wrong on the assumption that the technology platform isn't going to grow too much, but it looks like they guided for a 50% increase. When I looked into it, there's like some hints that they acquired a larger customer, a regional bank perhaps. But again, that doesn't really take away from my point that I still reiterate that I feel as though this company is going to have a harder time growing that tech platform if by comparison they were standalone business. Because at the end of the day, you just follow this train of logic and you say, hey, the point of you're my customer and I'm also competing against you. How likely are you to want to use my product? Let's say I have to win your business. Let's not talk about existing, because the products like Galileo and Technesis, well, let's pause on that. A general rule of thumb in any software business that gets involved with banks, most of the time, it's very difficult for them to switch. They don't want to switch. If it works, don't mess with it if it works, because any error can be quite critical. So it's very difficult to take something out once you're in the banking world. So general rule of thumb. And that's something that's attractive about some of these other legacy fintechs like Fiserv, Fidelity. They're really entrenched. And so it's very difficult for them to get out. Something big has to happen. So, but for customers that they currently have, probably going to keep it. But let's say new customers. So you have a bank and I'm going to compete against you, but I also have a product that I'm trying to also sell to you. Then there's another company that offers very similar offering of services. And they're coming to you and they say, well, we want your business too. They might even offer a slightly higher price, maybe. who are you going to go with? This is the same problem that AWS felt. AWS had no problem growing, right? So you could push back and say they'll have no problem growing, but I push back there and say AWS is a little bit different because AWS is applicable to all kinds of industries. Now, while Amazon didn't win too much business of fellow competitors, they did win business in a bunch of other industries that they don't compete in. And so that's why AWS is going to be different, because Technisys and Galileo are products focused on the financial space. And so SoFi is a financial platform that is going to compete against the likes of Robinhood, for example, because they have their own brokerage services. And then they're going to compete against other banks with other banking services. So you're going to have to make the case that you're just that much better, which it could be. You're that much better. And so you should use our platform instead of theirs. So, and then this is the thing. So FinTech Boy, this is the thing. This is what I'm pointing out. What happens? How do you convince me that I go with you rather than them? The answer is you're just that much better that I can't afford to not go with any other competitor, because you are my competitor and you have to convince me that you're going to compete with me while simultaneously I'm going to pay you for your services. Okay. Do you see how it can get problematic there? And I think that's what's going to cause a bit of headache for the growth in the technology platform in the future. So until I'm proven wrong otherwise, I'm going to remain skeptical on that portion of the business. Now, focusing on the bank, getting back to the bank, I don't know why we're so excited and eager to invest in the bank, because it's even a little bit different from the likes of the other hot bank stock is like Nubank. So Nubank is really revolutionizing banking in a country that has abysmal banking. There's a big difference. The United States has a very robust banking system. Brazil does not. Brazil has a whole host of problems as regarding their banking system for the middle and low class. For the high class, there's private banks that do just a fine job. But in the lower and middle classes, that's where you have a lot of opportunity for something like a Nubank to step in. So very different. I think a very different opportunity. Okay, so with our hoodies on, Nubank is very impressive. Yes, no, I would agree. Nubank is a very impressive business because what they're doing is they're actually they're operating in an arena where they're the only one doing what they're doing. If you look at a lot of the other Brazilian banks, those guys really offer a really suboptimal product. And again, banking in those countries, way different experience than banking in the United States. Trust me on that. Believe me, bro. So yeah, that's my quick spiel on SoFi Technologies. And I'm going to close the poll here. So, because I think you guys had plenty of time to answer this poll. And I think most of you answered no. Some of you said yes. So we do have some people shorting NVIDIA. What is this? Fubo, rest in peace. I have family members that are invested in Fubo. Oh, that's not good. Down 22%. Well, that's funny. Okay. Bank sounds like some kind of pre-crypto thing. That's funny too. Has been great. Congratulations. Yeah, I had no idea that Fubo was down too much, because like I don't even know how they don't make any money, but I guess because they don't actually get any economic benefit from the prices of the product, because all the monetary benefit is going to the sports owners. So rip Fubo. Well, easy money, guys. Are you short NVIDIA? No. You know how difficult it is for me to decide that I'm going to short something? Really, and I would never short on valuation. Something that myself, Dan, a bunch of other people have discussed. Shorting on valuation is kind of silly. Buying on valuation is different because you have time on your side. You can actually afford to be patient. Fundamentals we can disagree on, etc. And yeah, also comment. I guess I'll show. Let me see Twitter. I think it's. Oh, by the way, if you're not following me on Twitter, you're watching this on YouTube, you're not following me on Twitter, go follow me on Twitter. I post some funny things, in my opinion, some funny things. So I could be wrong, could be completely dumb, but I thought some funny things. Okay, so this is a tweet. A tweet that I shared. This is not my own portfolio. This is because I already shared my portfolio. This is one of our analyst portfolios, and this is Andrew. Andrew's killing it. This is per Fidelity. But the reason why I'm even bringing this up is because I think there's a lot of individuals out there that are selling courses that have bold claims without ever providing to paying customers the true performance. And they make excuses that, they want to be private. Nothing stopping you from showing a % return per the broker. Nothing stopping you from doing that. And you would remain private. We could all assume that it's $1,000 portfolio and you just killed it with $1,000. No one will know. You don't have to tell us. So that's the reason why I illustrated that. And I think that if you're watching a creator that's doing that, they're asking you to pay them for a specific product as to teach you something, then such as performing some quantity of % return, it is, I think, perfectly within your purview to request from them that they show you the % returns and that are, let's say, in line with the promise that they are giving you. So that's neither here or there. You know who I might or may not be talking about. You can use your imagination. This is actually quite applicable to many people. So yes, sadly. All right, Kevin might say not to be that guy. No, don't worry. We're really good on time. Let me actually check my. Yeah, we're really good on time. Good thing I didn't sell my ARM shares. Yeah, Kai. Good thing you didn't sell your ARM shares. But frankly, speaking, I think it's on crackhead prices. But congratulations. Still really cool that you own ARM. So I don't think the valuation makes too much sense, but that is just my opinion. And I can be very wrong. For example, I haven't had the guts to buy NVIDIA and I've just been wrong. While I'm perfectly fine and okay with not owning NVIDIA, and I think the portfolio has done quite well, NVIDIA has done really well, and I cannot take that away from NVIDIA. And, it was just very funny that a certain LeBron James of investing has shorted it. And as we discussed earlier in today's stream, I got nearly wiped out. I wish I had bought ARM shares. Well, there's nothing wrong with having that feel of, FOMO. There's nothing wrong. It's perfectly normal and natural. Just we shouldn't. I'm not saying you're going to act on that, but we shouldn't act using FOMO. But it's perfectly fine to go look back and say, dang, I should have done this. And now the best thing what to do is to use it as like a case study for yourself and say, what did I miss? Now, for ARM, I'm not sure if even going back in time, if I'm being honest, I would still do it. I don't think there's a scenario that back then that would have really convinced me to do it. Because all I see with ARM is just multiple expansion. The market is willing to pay more for the same set of earnings. Similar to, like, at least with NVIDIA, you have something that was, let's say, a real, despite what anyone says, it was a real catalyst, a real change in the business. Fundamentally, the demand is just insane. Thanks to companies that I own, like Meta. Meta is the huge driver behind NVIDIA, or at least one of them. Did you guys know this? That Meta is currently the largest owner of NVIDIA graphics cards. Fun fact. So you're welcome, NVIDIA shareholders. That's my investments operating income has, or at least large part of, CapEx has gone into purchasing your product. So you're welcome. And then another one of my investments was largely responsible for producing said product. So, hey, also there. ARM was valued at $44 billion by NVIDIA when they wanted to acquire it at the height of 2020 bubble. Now it's over 2x what it was at the peak bubble time. Wild. Yes. And so let's go back to ARM. So ARM is valued at $78 billion. crazy. Minor edit. Okay. Why is Western Union down 5% when earnings were very good? What was guidance like? I think guidance is going to be the key there. I haven't peeked at Western Union in forever, but let's see real quick. So let's see, Western Union. So this guide was. Okay, up 60% year-over-year basis allowed us to achieve the upper end of our EPS guidance. That's current. And then just maybe a different question on some of the guidance and the kind of guidance philosophy, particularly. So we just something guide did incremental Iraqi revenues. Oh, that's a mistake in the transcript. December discussion of this guide. Main focus we got is obviously on the top line and EPS. Sometimes you hit me items down. Let's see. Okay, here we go. So opportunity in 2024 as we gave him 50 to 100 million range. Okay, so answer the guide. The guide implies a quite uncertain 2024. There's your answer. I'm reading from the transcript. Just a quick find, but yeah, reading from the transcript, it seems like based off of the question Q&A, the guide that they gave out was frankly implying a bit of uncertainty. I'm a bit behind in your video, but on HBO Max being behind Disney, etc., in most countries outside the US, HBO Max isn't available as they have licensing agreements with regional operators. Oh, that's good information. Thank you. So, okay. Well, I do think that the streaming measurement is off the United States. And let me correct. Let me confirm because I don't know where it says it, but I believe this is just United States. So I can't imagine cable is that low globally. I think cable is way higher globally. National TV panel broadcast. Yeah, it looks like it's just United States. So from what I gather, this appears to be just the United States. Yeah. I don't see anything that's countering this point. But if someone finds that information better than me and my quick glance at this data, it looks like it's just the United States, which would again imply that in the United States, those are the breakdowns, the measure of dominance. I imagine globally, this might start to change. 4 days ago, it didn't open on my phone anymore, citing regional restrictions. Yeah, okay, so but that makes sense. So a bit of a legacy hindrance on HBO's content, which is unfortunate, but hey, they'll try to figure it out. I'll say this: the debt issue for HBO, and this is not, I'm going to kind of steal this commentary from club members, so I'm not claiming this as my own, but not WBA. Oh gosh, what is it? I had like a huge brain fart there. I just completely forgot the ticker. WBD. The debt breakdown of Warner Bros. Discovery, it has a really similar amount of debt to Disney, but between the two, I'm not concerned about either's debt pile. So looking at Warner Bros. Discovery, breaking down the debt maturities, you do have, I think it's a non-issue for quite some time. I think it like breaking down, it's like past 2027 is like most of it is when it's due, 2028, 2027. So they don't have much coming due in the coming years. And I'm going to repeat one of what the club member said as their opinion. So it's not my opinion, but this is their opinion. And I think it makes sense when you hear this out. So the argument is that Warner Bros. Discovery management should pay down the debt as it comes due and then use excess cash flows beyond that to buy back stock. Now, if you went off of my commentary previously on what I think the right valuation on Warner Bros. Discovery is, would be to hold off and wait on that just for a little bit, because it could get cheaper. And then I would then completely fully agree. Right now, what the company's been doing is, yes, paying down debt as it matures. But if you look at what their debt is trading at on the long end, it's actually trading at a significant discount. And paying it off now, you're actually paying off less than what you'd be paying in the future by buying back that debt. Sometimes companies have this opportunity to do that. Warner Bros. Discovery is one of those. Looking at Disney, they have a similar amount of debt, much larger business. With Disney, they have a lot of debt that matures in the far future. They have debt from 1993, by the way. I don't know if you guys know this. That expires or matures in 2093. Yes, you heard that right. 100-year-long dividend, not dividends, bond maturities. So, and then they have another one that they issued in like 2020 that had also a very extended long period of time for maturity. So for those ones at very low interest rates, by the way, for those ones, there's not really a reason or to pay that off any earlier. I mean, you could make the argument that right now it's discounted, but there's not really a reason. So they don't have to worry about rolling over the debt anytime soon. So Disney's debt does actually look better when you take that into consideration. So keep that in mind with Disney. What's happening to microcloud, hologram, holo? Can anyone explain how it just moved up over 1,000% just today? I'm also I'm not sure if I should put them even up, but I guess chat can answer that one. But I don't really know. That might be a nano cap or micro cap. Did you subscribe to the no ads on Prime, or do you still watch party commercials? No, I subscribe to no ads. Okay, Patrick already answered. Split. There you go, Jimmy. Split. Not sure, but the way I value them is 60 billion, 90 billion around there. Who knows? We'll see how Qualcomm answered back. Oh, you're talking about ARM. Okay, there we go. All right, so in conjunction, I think that covers pretty much all the topics for today. If there are any last minute questions, feel free to ask them now. Otherwise, we'll close it off here. And it's been a wonderful stream. I wanted to get that off my chest. But in summary of today's topics, we talked about closing the NVIDIA shorts from Everything Money and how that's a really bad idea and why they're silly, egg on face. We also discussed the earnings of PayPal, why that wasn't something that shocked the world necessarily, why retail investors continually seem to form cults around certain stocks, and that PayPal is not the worst one. It's not the worst one they've ever picked, and so it's not bad. But again, the narrative around PayPal being such a layup is driven usually or typically by people who missed out on certain other stocks. And so they missed out on Meta. And so they look at PayPal and they say, this is the same thing. I see that all the time on Twitter. I've even been seeing it on Alibaba, by the way. So Baba, same thing. For Hugh's question, how do I join the club? Well, the club link should be in the description below. If you click on that, it should take you there. And then you make sure you follow the guidelines, or not the guidelines, the instructions on connecting your Discord account. For someone who's not for Fabio, for someone who with a lot of uninvested cash sitting in money market funds, what would be like a good way to inch into the market? Sorry if this is too long a question. No. So this is a great question to answer. I will answer it without citing the actual source or study, because I don't have it memorized what the study is, but I'll describe to you in short what the research has to offer in this topic. So typically what you see when discussing should I dollar cost average or lump sum invest, the answer tends to be that lump sum investing has a much better outcome vast majority of the time in most instances. There are some scenarios where that's not the case, but and if we're talking about an index investing approach, the time to invest in an index was yesterday, meaning there's never a bad time to buy. The only the only reason why you justify a dollar cost average approach when you have a lump sum of cash, let's say you have a ton of cash. Let's say you have $1 million. You have $1 million sitting on the sidelines and you want to dollar cost average that $1 million, but you have $1 million, not because your salary is coming in. No, it's because you have $1 million. The only thing that's a benefit there is simply psychological. But the research shows that lump sum investing has better outcomes over a long period of time. And even when you look at I think when stock valuations are in the 97th percentile, which means they're generally overvalued to historical standards, then if the investor even waited for a 10% or 20% decline with that lump sum of cash, they tended to still do worse than had they still lumped sum even at higher valuations, which is really interesting part of the study that they found. So long story short, generally speaking, anytime you have lump sum cash and that's what it's for, you've designated, I'm going to invest that. Historically, it's been better to just lump sum and let it go. Now, when you're getting into individual stocks, there are, of course, a lot of asterisks that have to go on with this because now it completely depends on what you invested in. And you hopefully are doing enough of the homework to, have good returns there. But if you're speaking from the question or perspective of, when do I buy the index? The answer is always. And there's never a bad time to buy the index. So, yeah, I hope that answers your question. Oh, I know you've been a long time member, so I can pay you a fig of the legacy freemium version. So good to see that recently a lot of the, I think we don't really have many more of the legacy freemium members. I think all of you have pretty much converted. I think there's like only 2 or 3 of you, which is crazy. No, there's definitely more. There's definitely more. There's I have to check, but yeah, most notable, the ones I guess speak to more often than not. I think there's only like 3 or 4. But okay, so we'll be seeing you then for tomorrow's weekly call in ICOM then. So you have to complete the 12 labors of Hercules to join. So hopefully that answers your question. And yeah, and that's for anyone else who is thinking, what's the best way to invest capital? It's generally speaking, lump sum investing is the most advantageous method. And it's never, let's say, a bad time to invest. Now, with individual companies, that's a little bit more nuanced and asterisk, but yeah. So that being said, yes, lump sum index, this is the way. Let's go again. No, it doesn't get a rebranded name. So there's one more topic I wanted to cover. What was it? We covered PayPal. We covered NVIDIA shorts. We covered Disney. Yeah. Oh, I guess I want to summarize Disney. So Disney, I'm very satisfied with the earnings there. I think that the investment thesis there is playing out, and I'm really excited to see what the company does going forward. I am perfectly happy with even averaging up into this because all that the company is doing is basically getting in line with what I wanted them to do. There's no reason for me to punishing them by not providing more capital or not contributing more capital to the position. And, far and away, not wanting to let's say, detract from the position. So that's not even in the question. There are some other themes that are really taking hold in my portfolio. Primarily not too different from what I've already stated here on YouTube, but just kind of leaning harder into these themes. And I think it's going to be interesting. I think that Strongman Personal Finance is going to have a debate here soon at 9 o'clock. So I'm ending the stream roughly in line with where some of you might want to go check that out. But I'll say thank you guys so much for watching today. I really had fun covering these topics for you. If you guys enjoyed this live stream, feel free to leave a like and subscribe if you're not subscribed. If you're watching me on another platform, also interact with the video content there, like it, retweet it, etc. So yeah, that's the way it goes. I'll give you guys the chance of deciding, do you want the, actually, I'll pick a randomly which outro I use. And if you guys are interested in joining the club, the link is in the description below. What else? I guess I'll see you guys sometime next week because I'm trying to do live streams at least once a week. Yeah, I think that's it. We'll be seeing you guys, and you know what? I think we'll do the new one. And shout out if you guys know where the song comes from. It's a little bit on the nose, but
we'll do it live. Okay. We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah. Besides making these raps and complaining about school and fucking watching Entourage all the way through. Well, I don't know what you know, you can't fathom me and you can't handle low. But if you get it right, then you could get some more and you could get the better, you could get your hands on some.